Joining us today, Wilmington Trust Head of Investment Strategy, Meghan Shue, is with us. Meghan, great to have you back. I would argue you've retained some sense of caution even when the markets got a little excited and bumped up against this range we've been in. It certainly seems like that looks smart now in retrospect.
Thanks, Carl. Thanks for having me. Yeah, we've definitely been on the more cautious side of things, holding an underweight to equities versus our long-term benchmark for quite a few months now. And it's been a little bit frustrating to see the S&P 500 up almost 10% as of this week. But I think as we look forward, we still put a fairly low probability on a default. But I think as we move beyond that X date, we have to be looking at two really important risks. One is what type of spending cuts come with any deal. I think that there's going to be some cuts on the table, and that, in our view, just really weighs further on the slowing growth that we expect in the second half of the year. We expect a recession, so that just sort of drags it down further. And then the second is really two-way risk around interest rates, which have been getting a little bit more buzz lately as the Treasury sort of replenishes their coffers. Interest rates could move higher, but then as we move into more of that time frame for a recession, we think they move lower. So I think it's a really tough market, and certainly what's been helping to propel some of the stronger parts of the market has been that expectation of lower rates. So I think that's why it's something to be paying attention to.
If your second half recession playbook proves correct, I mean, what is the trade, given that we're still talking about resilient inflation, maybe a June meeting that's live? I mean, where do you expect the cracks to appear? Is it going to be in consumption or employment, and how soon?
Well, I mean, I think we're seeing some cracks already. It's just a little bit more in the manufacturing part of the market. S&P Global PMIs yesterday showing a pretty steep fall off in manufacturing export orders, but also some positive signs on inflation. So I think that's really the environment we have now. Inflation's moving lower, but we're also getting signs that growth is moving lower. I think the consumer has been that really bright spot for the economy up until now, and being propelled by excess savings, which will probably continue to drain and maybe drain a little bit faster if we start to see cracks in the labor market. But I think this is where it's hard, because we've been talking about this recession forever, it seems, and it has not come. But I don't think this is the time to capitulate. I think you have to just be patient here and wait for that story to play out. And we're just a little bit more defensively positioned with an overweight to fixed income, cash, and looking at those slightly more defensive equity positions, higher quality, things of that nature.